My colleague Jayesh talking about markets, but the biggest event of the day for the markets, money markets and the stock markets both have been the surprise announcement from the RBI on rates front and the commentary coming in from the RBI. So let's understand all of that with a very special guest joining us on the show, representing the banking industry, which is in the focus right now. Mr. Ahuja, Mr. Vishwavir Ahuja of RBL Bank is here with us to help us with his reaction and his analysis of the situation. Mr. Ahuja, very good afternoon. Thank you very much for joining us. Let me start by getting to know your thoughts on some of the announcements which perhaps you would have expected but did not come by. Every time we ask you, how do you analyze the announcements made so far? But let me understand what you would have expected or perhaps may come in the subsequent ones.
Yeah, thank you. Good afternoon, and thank you for having me. I want to actually respond in a positive manner today, because I think what the Reserve Bank has been doing is, it has come out very frequently and with a series of policy measures and announcements to alleviate the challenges that we are all facing in the country as an economy and in the financial sector, etc. So the government is doing its job, but I think Reserve Bank has, according to me, done a phenomenal job in doing everything that is there in their power to address the challenges that we are all facing today. So in that context, I think again today they have shown time and again they're not sticking to any rigid schedule, and that they would come out and take measures and announce measures as and when considered necessary, timely and appropriate. So from that point of view, I'm actually very encouraged that they continue to do that and continue to maintain a very accommodating stance as far as policy initiatives are concerned. What was expected? What was expected was that there would be an extension of moratorium, obviously because the lockdown has persisted longer than originally planned for or anticipated. So this is something that I think across the board there was anticipation this would happen. It has happened. Yeah, I think in addition, recognizing that cash flows may not be sufficient, to service debt, because the interest burden will get bunched up, they have allowed coming out of that. That is also a very positive practical measure. Rates have been further reduced. Yeah, so whatever fillip that they can provide from the rates point of view, I think that has also been done to bring down, if I may say, cost of funds, etc., and to encourage some credit activity. I can understand that there is risk aversion and purely rate reductions will not achieve the purpose. But having said that, it can't be treated as a negative measure. It is at best a neutral to positive measure. I think the one other thing that I want to comment about, that what people were expecting was perhaps that a one-time restructuring or something like that would perhaps happen. Now, I have my own view on it, and I'm sharing my personal view. I think it will come. But perhaps the timing was not appropriate for that today. Yeah, I think lockdown is just about getting eased. I think there is a sort of partial lifting of lockdown. Some economic activity is being allowed to be revived, and I think it is very early days yet to basically be able to measure the impact of that, to estimate that, and then, in fact, when this restructuring should be announced, I think that timing, we need a little more time to figure that out properly. And I think that is why perhaps it was not done today. And again, one can understand the logic behind it. So therefore, I would not consider that as an expectation that has not been fulfilled. So that's where I'm coming from. If you allow me, I want to make one more comment. Well, what has really changed, factually changed between yesterday and today? Today the governor has spoken. I was hearing several commentaries from many other people today, and I think the general negative feeling was that, he came out as a bit somber, recognizing that the economy and the GDP expectations maybe, less than what was previously predicted or estimated. And I think by so acknowledging, I think it's again a very realistic thing for the governor to have done. I mean, it is practical, it is upfront, and an acknowledgement is therefore not a negative thing by itself. If they had not acknowledged, I think that would have then caused more questions to come. That the whole world is facing a negative GDP scenario. India can't be any different, and I think our regulator and other powers to be have not acknowledged it. So they have acknowledged it, and I think once having acknowledged it, they're also saying that all measures that can be taken shall be taken. To make sure that the impact on people, society, businesses, and economy as a whole, shall be, mitigated to the best possible extent. So that would be my, overall, if I may say, take on today's announcements.
Right. Mr. Ahuja, that's a very balanced way actually to look at things. I mean, not to take away the fact that RBI has been on the forefront and have, taken feedback from the industry and kept on again and again so far coming out and helping and cushioning the blow. Perhaps the exact perfect time for one-time restructuring for specific sectors may not be here yet, and who knows, as you just said, may come subsequently. But let's take, forward the points made so far. You are, one of the foremost, private sector banks there. What kind of conversations are you having with industries on ground? What situation are there, businesses in when they come to you for working capital requirements and other discussions? Because RBI governor today also clearly, acknowledged that perhaps the first half of next year the growth could be negative, only to pick up subsequently. Is it matching with reality on ground? Give us some feedback.
I think absolutely matching with reality. The fact of the matter is that in the first quarter of this fiscal, economic activity has been, very, very, very shallow, near almost nothing, one should say. Yeah, so in that sense, but having said that, as of the last week or so, many things are coming back. I think shops and establishments are opening up. Offices are also seeing more activity coming back. Many factories have reopened, although they're operating at 40-50% capacity, but nonetheless, they are opening up. I think once the transportation and other bottlenecks are also, if I may say, eased up, I think that will pick up even more. So, yes, there has been an impact, but we also see the fact that activity-driven cash flows are also starting to come back. In the meantime, there have been some countervailing factors. When it comes to, a lot of stuff that people can do online, I think those transactions have just shot up. I think there is enough data available, to prove that point. So there are also a new paradigm that has now set in terms of very effectively how people can even work from home. So I think lots of new and interesting learnings are coming from this experience, which is actually going to suggest that in future, as and when things get better, and we can go back to normalcy at some point in the near to medium term future, one can actually function in a much more effective manner. So there are a lot of learnings. Now coming to specifics from our bank's perspective, I think we did some commentary post our year-end results a few days ago, and I'm very encouraged to state that when it comes to the corporate space, which is our wholesale banking customers, they are both in the large corporates and mid corporates. I think the moratoriums that were initially sought have come down, in fact, significantly. We had reported that little over 20% of the value, in terms of value and number of customers, had sought moratorium. I think many of them have reevaluated their cash flow positions, and this has actually come down. Many of them have paid not only their April interest, they are going to be paying their May interest, and so they also believe that to the extent that they should maintain a lower burden of indebtedness and pay what they can, it is a good thing as long as there is some cash flow that they can see. And initially the reaction was, let us conserve liquidity, but I think all are realizing that this is going to be a slightly longer haul, and they're also probably expecting that from a policy perspective all measures should be taken so as not to increase the burden on business and industry. So I think this is something that we have seen as a very positive sign. Almost 7% is the reduction in moratorium we have witnessed only in the last 3 weeks, from 20-odd% to under 15%, close to 13% now. Even when we look at on the consumer side, where our largest business is our credit card business, where we have 2.8 million customers. Initially, spends came down dramatically. I mean, we have reported that spends came down, almost 55-60%. In the month of the few days of May alone, spends have gone up from that level by 40%. So, in other words, spends have gone up. And when I say that, many of the card customers, who may have chosen to take moratoriums and therefore their cards were effectively blocked, have unblocked their cards because they want to once again, start making payments. They are doing online ordering. They want to maintain their credit scores. They want to maintain, activity to go on. And I think there again, actually, interestingly, moratoriums have come down significantly in terms of percentage of customers and value. So this is a very positive development. It indicates a customer base which is, which wants to continue to, look into the future with optimism and are, and can afford it, and they're doing it.
Right. That's a very interesting consumer insight which you shared, Mr. Ahuja. In light of the way some of your private sector peers have been, providing in their books, making provisions for what lies ahead in couple of quarters, perhaps do you think they are being cautious and conservative, and the entire sector, once bitten twice shy, perhaps is preparing for the worst, and perhaps things may not turn out as bad on the NPA cycle front as we have seen in previous cycles?
No, I would not go to that extent. I think from the point of being conservative and making accelerated or additional provisions, we've all done that. Even we have done that in a very significant way. Yeah? And we took some COVID provisions. We increased PCR from 58 to 65%. We did many other things. And I think we did accelerated provisioning. So others have done it, we have done it. But the situation does vary from bank to bank. It's all a question of what kind of customer profile you have. When we look at our bank, I have commented earlier that actually I don't see credit costs going up. If anything, for us in particular, credit costs will go down. Because last year we had the overhang of a few corporate accounts, which, increased our credit costs. And those have been fully recognized and almost entirely provided for. So therefore we walk into on our corporate book, very clean into 2021. So our credit costs from the corporate business, except the few which are going to be impacted because of COVID. And honestly, if you take the affected industries, this is a point we made in our analyst call, and I'm saying it repeatedly. We have a single digit or less exposure to the 5, 6, 7 major affected industries of travel, tourism, hospitality, organized retail, logistics, etc., and so on. So, and I think, therefore, if I look at our customer profile, whether it's on the corporate side or it is on the card side, which are again, a very well-positioned portfolio. These are solid customers who have got other cards of at least one of the top 3-4 banks, who are not new to credit, who have been well carded in the past, and they're paying, like I said, a significant majority, almost 80% of them are still paying regularly, and the others have, of course, accepted moratoriums, but that doesn't mean that, these are bad customers. So the point I'm saying is it's all a question of your own portfolio. The other big business we have is our microbanking business. The interesting thing is in the couple of weeks of May, we have opened almost 750 to 800 out of our 1200 rural branches. Yeah, and I think center meetings have started, and I think the engagement with customers has started, even though this customer base in the microbanking portfolio continues to enjoy moratorium, and they should. But they are eager for their economic activity to come back. The good thing is, much of these areas are in the green space.
Right. Right. I think I'm losing you there, Mr. Ahuja. But it was great to have you on the show, Mr. Ahuja. Wonderful insights shared by you, and of course analyze today's commentary in a much more positive manner compared to what we've been hearing since morning. That was Mr. Vishwavir Ahuja, MD and CEO of RBL Bank. Guys, with that, it's back to you. Mubina, you may want to listen to that insight on consumer behavior via the credit card holders of RBL Bank later, and we'll build upon that.
Oh yeah, it was very interesting, especially when he said that the number of individuals opting for the moratorium has actually seen a drastic reduction. So, I mean, things are slowly taking a positive turn. So maybe the next set of the moratorium, June to August, may actually see a lower number. Let's see what banks have to say about that. But with that, I think we'll have to slip into a very short break. Don't go anywhere.